Welcome back, everyone, to the Mortgage Heroes Weekly Podcast Show. I'm Andy.
I'm Brian.
And I'm Will.
So today, guys, we have on deck 4 different topics. We have real estate inventory growth is low. Home sales fall again in July as supply drops to near a quarter-century low. Mortgage rates hit their highest point since 2000. And weekly mortgage demand drops again while interest rates match a 22-year high. This is going to be a wild ride, but before we hop on this train, we have to introduce everyone in our audience to Lonesome Mike. Everyone, welcome Lonesome Mike. It's not because he's lonely. It's because he loans some money. Thank you very much.
Oh, okay.
And thank you for that intro, Andy.
Yeah, you got it. So Lonesome Mike's going to be joining us off and on the show throughout, and we're going to see how Lonesome Mike does. Thank you for... And we'll appreciate your comments. Let us know what you like about Lonesome Mike.
Please only speak when spoken to.
That's right.
Thank you.
So we're going to get right into it. First up today...
Mike, you can respond.
First up today is despite higher mortgage rates, guys, inventory growth is still slow. So weekly active listings rose by only 4,401. Mortgage rates went from an average of 7.19 to 7.37, and purchase apps were flat last week to week. What the heck are we going to do?
Jesus, what are we going to do? It almost seems like the redundancy here.
Yeah, I know. It's kind of like going on the carousel round and round a little bit. But, we're in the 7 range. I talk on Monday Mortgage Minute about the 10-year yield, and we talk about how that's going to impact rates and how money comes into mortgages or mortgage-backed securities or out of mortgage-backed securities, make them expensive or cheap. But this is clearly a problem.
Yeah. Absolutely. We're going back to sellers just being hesitant. Mm-hmm. They want to be on the sidelines. Why do I have to sell right now, especially with these higher interest rates? They were high already in the 5s. When they're in the 5s, people were hesitant.
Yeah.
Now, let alone we're in the mid 7s. As a seller, I'm going to relook at my things. Do I really have to move out there?
Well, even just simple math. Like if someone was at 2.5 and then they see 5, you're like, that's already double in their mind, right? Even though I know it does not proportionately double when it comes down to the rate, the monthly payment. But in their mind, they're like, oh, I'm at 2.5. I'm going to 5. It's crazy. Now you're trying to tell me 7.5. Now it's 3 times where I was at.
Absolutely.
It's like, I don't know about that.
Yeah, I mean, we're here. People have the golden handcuffs on, and everybody has a sub 3% rate. So for them, it's like, why am I going to make a move when my payment's so low? And houses are only double the price that they were when I bought this one. Yeah. Rates, so I mean, look at the way that they are. Yo, I'm staying put.
And you know what? I think this is something where, months ago we started talking about how this is all going to be the needs-based economy when it comes to real estate. It's like I need to this or that because of this or that.
Absolutely.
And I think we're just going to see more of this. The forecast is that, obviously active listings have been down year over year for a couple of years now, actually lower now in 2023 than they were in 2022. And that was even lower than they were in 2021. Now, I'm not saying it's going to find a rock bottom and become zero. It will not be because people are living life. However, the amount of volume of homes coming onto the market is going to be paltry at best for, I think, the rest of 2023.
And I mean, we're going already into the slowdown periods of the real estate market towards the end of the year. So even more of a slowdown period that we're going to start seeing people with holidays and everything probably holding off until next year to see how the market performs. But I feel that in that pocket, there's still going to be some really good opportunities if you're able to just, play your cards the right way.
Absolutely. Yeah. 100%.
I think this is like that double-sided coin thing where, you start to get to this part of the fall where you go, okay, people who are still serious about getting in a home, it was like their goal of 2023, like they're going to press ahead. They're going to be like, have a little more grit and persistence, and they're going to make it happen. They're going to find something, and there's going to be someone who has to sell a house because of whatever need they need to. Then there's going to be others on the other side of the coin. They're going to pump the brakes probably and go, you know what, let's revisit this in the new year. And new year doesn't mean January 1st, by the way. New year usually means into February, maybe March or that spring season where maybe there's some more choices. We've got another 6 months under our belt, and then we can make a better choice.
Yeah, the other thing is we have elections coming up, right? And so we already know that's another thing that actually persuades things.
Yep.
That actually makes, hopefully, interest rates kind of, let's start going down. I don't want a president and have all these high rates, you know what I mean? And so
one of the things that I have been noticing is that everything's based off the sentiment that the reports, come out and say. So if the connotation of what the message is good, people are going to say, okay, that could be taken as, positive information that rates are going to come down. But if they come and say like, hey, we still aren't done here, we could continue to see rates to continue to go high and keep course.
I think September is going to be that key point. I mean, I think by September we're going to know if we're going to call, the Fed's going to like really display their shot. Like they kind of already called their shot, and they've been raising rates since March 2022. But I mean, this September meeting now has kind of everyone's attention. They're coming out of the Jackson Hole Symposium meeting that they just had. Now they're going to go into September while collecting all the data they were saying last meeting they need to make in this upcoming one in September, and then we're really going to see how the cards are going to fall.
All right, rates going up.
rates I feel will remain where they're at, and higher chances of them going up than them going down.
Okay. Fed's increasing rate?
The Fed will increase rates probably in September by another 25 basis points. That's my current bet.
Last year
me
when
too.
when they met at the Jackson Symposium, wasn't it around the same time? And then into the following months, October, November, we saw the highest rates that we've seen for 2022 until they started to come down a little bit into the December early years and then spike right back up when we got into the beginning of the year where buyers started getting back into the market.
Well, and remember, it was not only when they were thawing out and coming to the market, but February is when we started having SVB and the other bank issues. And it's like, oh, now we have a systemic risk. But they also, remember, we had made the point, they can't take their foot off the gas pedal because then they're admitting that the systemic risk is a bigger deal than fighting inflation.
Yeah.
So they were caught and cornered in that situation, which we're not facing now, I don't think. But the recent downgrades of other banks is now going to be a problem going into the end of this year and 2024. Guess why? Because of the same reasons that SVB had some failure points too, which is the Fed keeping rates so high is really causing those bonds to lose value tremendously. And there's only so much time these banks can hold on to these at those underwater levels before it starts to become problems on their balance sheet.
Yeah, no, that's crazy. So I mean, inventory is still low. We still have a lack of new construction. We have a labor shortage. A lot of construction workers aren't going back to this workforce.
Well, funny that you say about the home builders. A lot of people right now, I'm noticing that rather go into wanting to buy a new home because they're saying, hey, well, it's brand new. I'm already spending this much on it. Might as well get myself a brand new house than something that's been, built for years. So that's something that I am noticing where people are starting to submit more applications or show more interest towards new builds, but then at the same time hold cautious because it's not always, the best decision down the line as we've seen. Even builders are facing a lot of problems. Houses aren't getting done when they need to be done. But still, I mean, it's something that I have been noticing a lot.
Yeah, and personal experience, you think everything's good. It's a brand new house.
Yeah.
I bought a few properties brand new. But what we don't realize is now I have to do the yard. And then when you get the yard, you have to get some type of contractor, landscaping contractor, in order for you to submit your plans to the homeowners association. So that costs some money, almost like having an architect.
Oh,
right?
yeah.
And then you're doing all the other work, and next thing you know, like, oh, this is around $140,000.
Starts running up.
You're like, okay, with inflation the way it is that the best decision to make right now?
It's a simple comparison to the stock market, right? You're buying at the highest, and when it drops, you bought at the highest, and then now you're going to have to wait a long time for it to go right back up,
Yeah.
So it's about identifying the right deal that makes the right numbers, because even in this market with the rates how they are, with the numbers the way that they are, if the numbers make sense, the numbers still make sense.
Yeah,
and
exactly.
That's all that needs to really happen.
Yeah, the funniest thing, going back to that story, when we had dirt backyard, right? Because we thought we were going to go in there and just go, hey, you know what? We're going to fix it up. Kids would go out there, and remember, I had Christian, Ashton, and Dylan.
Ooh.
I mean, Christian, Ashton, and Devin. They'd go out there. Next thing you know, it rained. They're all muddy. I'm like, stay out there. You know what I mean? It's like, because it's all dirt. It's like, I mean, these kids are just nothing but kids. They want to play. And so that makes you want to get the yard done sooner and just get more in debt.
So the mud made you motivated.
Yeah, that's what I was saying. Well, now you're talking about carpets. Now you're talking about the furniture getting all dirty. Yeah.
And you know how I am with my...
OCD. OCD.
Go outside, stay outside.
Here's the hose. Don't come back into it.
Well, last thing on this, guys, with inventory, obviously watching this into the fall, going into the winter, just for perspective, I want to lay this out there so we can come back and watch this later and we'll see what happens here. But, week over week, or this week in the year compared to last week in the year, 2023, there's 60,295 listings. In 2022, there was 68,167, so 8,000 more. And then in 2021, there was 80,898. So a substantial drop off from 2021 to 2023, comparing week over week or week to week of the same year. So 20,000 fewer listings in 2023 than this same week in 2021. Wow. Let's move on. Our fall and winter outlook is going to be a little bit tough and challenging. Wow. So
it is.
All right. Home sales fall again in July as supply drops to near quarter-century low. The median price of a home sold in July was $406,700, which is an increase of 1.9% from July of last year in 2022. Sales fell month to month in all regions except the West. And there were 1.11 million homes for sale at the end of July, 14.6% fewer than July 22, and about half the pre-COVID supply.
Wow.
So we're missing a lot of houses.
Dun, dun, dun.
So interestingly, though, one of the things that I have noticed, and they mentioned it here on the the article is that the demand for FHA's loans has increased, and I have seen that because a lot of people are starting to hit the predicament where their renting situation is not that far off from what a mortgage would be, and especially here in San Diego, in the eastern part of Chula Vista, or anywhere really in San Diego, you're really facing the crisis of rents going up, mortgages going up, and the financial situation of where you're at right now isn't making sense anymore. So you rather have something that, you know, down the line can help you in any financial way, or you're really just throwing away down your money towards somebody else's investment.
Yeah.
Essentially.
I mean, it makes sense. You have a lower interest rate,
Yeah.
right? It's government guaranteed with the Federal Housing Administration. So therefore, your interest rate's going to be lower than a conventional. And then your mortgage insurance, the good thing is they reduced it.
Yeah.
You know, so that has a huge effect on why people are making a decision to go towards FHA right now.
Yeah, and even if you have solid credit, the MI is going to be low. Sometimes it's going to be a little bit lower than the conventional, depending on your credit. But it is a good opportunity because I have seen that give buyers a little bit more purchase power because of the fact that the numbers sometimes are a little bit lower with the rate, and conventional being so strict on, you know, your finances and your income and your credit. You know, there is options out there.
Yeah, and I think that it is really a test and a battle of people's persistence and their perseverance. I mean, you know, I was reading here, you know, sales are 16.6% lower compared with July of last year, and homes sold at the slowest pace since July 2010.
13 years ago.
13 years ago, but also coming out of a massive catastrophe in real estate and mortgage. So, like, my note to myself was, is this another warning sign, or is this a test for the market? I mean, it could be either one. It could be both. It could offer itself up as a warning sign, but also be a test for the market to see how resilient it is and how resilient buyers are, and whether or not this is looking down the line historically, we could go back and go, oh yeah, that was the turning point. That was another 2010 moment in 2023. Not sure about that yet. Yeah.
And you know, here's the craziest part too that was cool about that article is, even with the rates rising, it so seemed that the regions here in the West, we were still buying.
Yeah.
You know, we weren't hesitating. Let's go. Let's buy.
I think San Diego still, for that matter, is like still very competitive compared to any other market that I've heard. And I've been seeing it even when we spoke to the account executive from the East Coast. He's like, San Diego's the last one to feel anything in the real estate market. You guys are still, it seems like it exactly. But because the competition's still there, I mean, multiple offers. Yeah. It just seems like it's not slowing down.
So I'm going to ask you guys both the same question. How much of it do you think is being driven by FOMO versus needs?
Oh, man, that is a good one. That is good. That's a tough one.
What do you think it is? Do you think it's people that think it's a fear of missing out, or do you think it's that they need to buy?
I think a lot of people, it's fear of missing out. I really, really do. That's, if you kind of think about it, it's like, well, my neighbor has a property or my friend or my family member, like, why can't I do it? You know, and so they'll go out there and do it. And it's kind of getting people to just not be patient with it and let me just get into the market now.
No,
I mean, there's nothing wrong with it either.
Yeah.
There really isn't. You know, again, the best cliche I've been hearing is, don't marry the rate, marry the home.
Yep. I think for me, it's going to be a combination of both because of the fact that, a lot of people once 2 years ago, they didn't buy, and now they're seeing everybody have that low rate with the golden handcuffs. Then they're starting to see their needs like, yo, my rent's not going down. My bills are getting more expensive. Like my energy spending is getting more expensive. Everything's getting more expensive. So I think it's a combination of, dang, I should have bought when they told me to buy, and now I really need to buy, or I really need to make a pivot in my situation because my needs are a lot different than what they were 2 years ago. And that's one of the things that, you know, right now is the conversations I have with my clients where it's, well, what's the goal for 5 years down the line, you know? And if you have a clear path or some sort of an idea, it's going to help you make better decisions. Knowing that you have a plan down the line that's going to help you create that pathway. So I think for me, a lot of people know that they missed out, and now their needs are like, hey, yo, I need to make a choice here.
100%. That's actually great information. Like, it's true. A lot of people, the clients 2 years ago, you know, we had them approved. They're ready. So we just do a follow up with them, and they're like, no, I'm already priced out of the market. I can't even do that. My income is fixed. So
I had a client that came in. We approved him in 2020. He had a 2.75 rate conventional purchase, right? And I pulled up his application. I was like, ooh,
Well,
He's like, well, I'm like, the rate is just not there. Like, I mean, and he knew too. He's like, I know, I waited, this and that. The income was there.
Yeah.
Luckily, he still has, significant income, but it's a complete different situation. You're talking 2.75 to 6.25. Like,
so what's my rate now, Brian?
Yeah, I told him, I was like, well, add 4 more points to that.
Oh man, that's crazy.
But that's the reality, and that's why I said, like, he tried to say, no, I'm going to wait it out, but eventually,
And the funniest thing, when you would do that and tell people, I'm approving you at 2.75%, they'd be like, can you go lower? What would you think that client would say right now?
I'll take anything below 6%.
I'll take 2.
Right?
Okay, Lonesome Mike, let's ask you, FOMO versus needs. What do you think is driving buyers in the West still? Good answer.
Thank you. Appreciate that.
Okay.
Did you know Cal Hapa is making a comeback in 2024?
Okay, Lonesome Mike, FOMO versus needs. What do you think is driving buyers in the West?
I would say it would be FOMO because I know a lot of people are renting right now, and like Brian was saying, rent for the most part right now, although it is still going up, and San Diego is now the most expensive place to live. It can be still cheaper than a mortgage, so I feel like maybe the need isn't quite there especially for younger people as well. So I would say, especially younger people buying right now in this market, it would probably be a fear of missing out.
Yeah, I think so. I think it's a little bit of both. Again, and you made a great segue to what I think my takeaway is on that is I think it's both depending on who the buyer is.
Yeah,
so if it's a buyer that's young, maybe there's a little bit of FOMO. If it's need-based, your family's expanding, or you've gotten promoted at work and you want to finally stop being a renter, maybe there's FOMO plus needs of expanding the family. But then also, I think whether you're an investor or not, like investors right now that were using debt to finance their acquisitions are a little bit more tepid right now. But here's the thing. There were still 16% of homes in July that were purchased by cash and investors.
I know.
Investor cash.
It's crazy.
So it's still happening. So I do think it's a little bit of both. And then I have to read this part from the article because it reflected some attitude and behavior that I think we need to be conscious of and keep our eye on. This is from Danielle Hale, chief economist at Realtor.com, who says, home shoppers have seen the number of options dwindle as homeowners are largely content to stay put and enjoy their current home, especially those with a low mortgage rate. This, I think, is going to be the story of 2023, moving into 2024. It could even carry in higher than that, guys. But we're going to go right into the next topic, which talks about this exact issue, which is mortgage rates hit their highest point since 2000. Yeah. By the way, real quick note out the gate, both of us started loans in 2005. Well, 4 or 5.
Yeah, 5.
So in 2000, we weren't even doing loans, and I don't even know who it was writing loans in 2000 that's still writing loans now.
Yeah.
So now we're talking about in the industry people who may not have even lived and written loans at this rate 23 years ago.
But Andy, were we originating loans when we had an acronym like NINJA? Right? You remember that?
Yeah, they still classify it as originating loans, but I think that it like dawned on me. I'm like, that's 23 years ago.
Yeah.
And 23 years ago,
Mikey was born.
Lonesome Mike.
Lonesome Mike.
Lonesome Mike
was barely born.
Twinkle in the eye. Welcome. Come on, welcome to 2023, Mikey. But look, it says mortgage rates soared to the highest level since November of 2000, crushing affordability for potential home buyers. The average rate on the popular 30-year fixed mortgage hit 7.48%, according to Mortgage News Daily, and the average of 30-year fixed last year at this time was at 5%.
That's crazy.
So we are definitely facing headwinds, uphill climb, however you want to talk about it, however you want to say it. This is going to put immense pressure on real estate. It's obviously putting pressure inside the industry, but I think something that people overlook is the ripple effect this has on related industries to real estate and mortgage. You're talking escrow, title, appraisers, inspectors, which then can also include local plumbers, electricians, air condition repair people, flooring, tile. You're talking about painters, garage door repairman, like you name it. There are things that are connected to this that are going to be feeling this pain.
Yeah. Yep. I agree 100% with that. Going back to the origination on that with the whole NINJA acronym, The reason why I kind of laugh at that is because at that point in time, it was, you were barely.
I just
You're
graduated.
in
I just
kinder.
promoted a sixth grade going on to seventh
here you
in
go. That's
2005.
crazy. So Ninja, it stood for no income, no job, assets.
Oh, it's not.
And
like
that's what I'm
Japanese.
saying. Is that really considered origination, right? When you're just taking a heartbeat, a heart pulse, and credit score, and you're running and you get a loan.
good.
Like there's nothing. You don't even fill out an application. So.
No, it was
But-
formality at most.
But yeah, going back to this, Andy. I mean, these are just great information. It's just crazy to think 23 years ago the rates were, that low, high. I want to do here an example. I did an $85,000 annual income, which equates to $7,083 per month. And that got you with a 20% down payment. You could afford principal, interest, taxes, and insurance, a payment of $3,400. That would just put you under like a 49 debt to income ratio for conventional. Yeah. So here's the power of the interest rate. And that was at a 7.48. Okay. So we did another same scenario, but with 5.5 interest rate. That got that same person to get approved for $593,000. That's $93,000 more.
Wow. That's
So
crazy.
that's the power of an interest rate. That's
it's
what it does.
500,000 at 7.48% and 593 at 5.5%.
5.5%.
That's a huge change.
And those are the things that we're facing right now with the rates. It's just diminishing the buying power for people. So if we have these people that are just looking, just with that quarter, 0.5%, 1%, it's just diminishing their buying power.
I think a huge advantage is if you're coming in with 20%, instead of putting down that 20%, take some of that 20% to bring down your rate, because that A is going to help you approve for more. B, your payment's going to be a lot lower, and you don't have to basically put down the whole 20. Be strategic about it, because I believe 10,000 only equates to like $30-$60 in difference of payment. So you're better off buying down the rate, because you're going to save upwards of 60 to 70,
Yeah.
and now it makes a lot more bang for your buck if you do it that route.
Yeah, probably a much more strategic approach if you have that much cash on hand
Yeah.
to
If you
make
have
it better monthly for yourself.
And again, every situation is different. I want to just compare this to what the difference is in a rate of 7.48 versus
huge.
5.5, right?
So check this out, though. And something about this that kind of jumped out when I was reading this. I was like, wait, what? Is investors aren't seeing the kind of deterioration in economic data they expected. I was like, I know that they've been saying that. I know, because I talk about this all the time on the show, but I'm like, what? Like it seems so mechanical and it seems so uncompassionate, but it is a truth that I think we're dealing with, because on paper, these are just numbers, but that represents the difference of someone being able to get into a house or not.
Correct.
And that, I think, is a real sad story. That's a sad state of where we're at right now.
Yeah.
I feel the Fed's taking the stand like, when you're in a scary movie and the bad guy's chasing you and then they hit him and then he falls and then he's kind of dead, right? But everybody's like, okay, good, he's dead. Yay, let's go on, get our life. And then they go, walk, boom, shows up right in front of him. That's inflation. And I feel the Fed's like, no, we got to make sure it's done, it's dead. And we're going to even overkill it. And then results to what's happening.
Yeah.
Good analogy. I don't watch scary movies.
Me either.
And
I heard.
And I think to that point that person's gonna keep getting back up again and haunting us, because I think we're gonna see higher rates for longer. Is one of my other outtakes from this is noting that the Federal Reserve wants to see the same deterioration before considering a policy shift, and that shift would likely favor short-term rates first. Well, we're talking about mortgages. Those aren't short-term rates.
Yeah.
Those aren't your car loan, credit card loan situation. You're talking about long-term rates, which means we're probably going to be the I don't want to say beneficiaries. We're going to be the punching bag for some of this economic correction that needs to happen for a while. And again here, the net effect is that longer term rates like the 10-year Treasury yields and mortgages are bearing the brunt of the market's negative rate sentiment. This won't change until the data forces the Fed to start talking about the first rate cut, which we just talked about on their own chart. They signaled is not going to happen until 2024 or 2025.
Wow.
Investors and everybody takes that information and takes it as negative. So therefore, course, rates continue to go up. But another thing I did see on here that caught my attention was a lot of people, well, not a lot of people, just last week, 6.2%, according to the Mortgage Bankers Association, started looking into 5-year ARMs. And before I got into the industry, I watched The Big Short, and, I thought ARMs were like the devil, like everybody listens to an ARM, and it's like, why would I want an arm when I could get a leg?
Yeah.
But no, in all seriousness, once I realized how you can leverage an arm if you understand it and actually know how to utilize it, right now, I mean, compared to the 30-year fix, depending on your financial situation, that could be an option that could save you a little bit more of money or get you into that property that you want. But always knowing that you have that exit route, you already know how you're going to plan out to make your exit from that loan, because it's a temporary band-aid depending on your situation. It could be, you know, a deal maker, a deal saver, and you know, I thought that was very interesting. But I would just caution people that if you do take that route, understand how it works, understand, you know, the good, the bad, because obviously, you know, there is a risk, but then there's also a gain if you're able to utilize it and leverage it the right way.
And there is an ugly.
I don't know if you guys know, but who has the best arms in town right now is Mikey. Lonesome Mike. Yeah, Lonesome Mike with the best arms
that wasn't
in
an
town.
alley-oop or anything, huh?
Yeah, Lonesome Mike.
He's got the arms.
All kidding aside, this is actually a great example of date the rate and marry the home.
Yeah.
Because you could date that rate for a short period of time, get yourself in the house. You got that FOMO or that needs base, get yourself in. Yeah. And then you can adjust and modify that later. Yeah. The current environment that we find ourselves will not be the landscape forever, just like it was not forever in 2008 or 9 or 10 or in 18, 19 or 20. It's not going to be that way forever. Things will change. Your life will change. Your needs will change. The market will change. But the arms are a way to get your way in the front door.
Yep. And arms, it's for an adjustable rate mortgage.
Yes, not literal arms for those of you who want to fact check and comment. There you go. All right, guys. So we're gonna try to end this on a high note, but it does start off a little bit of a dour side. Weekly mortgage demand drops again as interest rates match 22-year high. We just talked about them being the highest they've been since 2000 and last 23 years. Mortgage demand from home buyers was 26% lower than the same week 1 year ago. Applications to refinance were 35% lower than the same week 1 year ago, which is also lower, by the way, in 2022 was lower than 2021. Yeah. So that is just continuing to roll downhill. And again, mortgage rates rising to their 23-year high, 23-year high, depending on who you're asking. Yeah. And mortgage volume is just low. It's just the state of the union, guys.
I think we're going to go through this till 2023, and I think we're going to finish with 2023 with the same type of numbers. Yeah. 2024 is going to be a different dance for all of us. Yeah. But I have here, I asked, what's the prediction for the next 2 years? Zillow predicts that we're going to see a rise in prices by 3.5%. So I'm like, okay, 2024, they're predicting about 3.4%. So for all those people, FOMO, just do the math. If your average, house in San Diego is 890,000 is what they say currently. Multiply that by that 3.5. And then you'll see what's going to happen with
it. It's about 30 grand.
There you go.
Yeah.
Thank you.
Easy numbers, right?
Human calculator, la máquina.
Yeah, there you go. And then CoreLogic, they also predict that prices will rise. They say in about 4.2% in 2023 and 3.2 in 2024.
Mm-hmm. And I think that's correct. I mean,
supply
and demand, like it's not there. I mean, the numbers look pretty accurate because of the fact that, a lot of people still want to get houses. The rates are basically hindering as well. But there isn't houses, and there's still a lot of people that want to buy houses.
That's right. That's right. And then we have Freddie Mac. Freddie Mac actually predicts that home prices will rise by 5.2%.
Oh, they're bullish.
They're bullish. Oh. But then check this out.
Wow.
And then 2.8% in 2024. And I've been hearing some people talking about that 2024 being that, we're going to start seeing more inventory. We're going to start seeing more of that. That down market. So who knows? We'll see.
Well, I think this is a story of resiliency. And then it's kind of mentioned into the story, which is like the resiliency in the consumer side, the resiliency in people to be paying the prices they are now, even with lower inventory and higher rates and people still buying houses either because of need or because of FOMO. There's a level of resiliency that it's hard to measure, but we know it's there.
Correct.
And it's that resiliency that we're also telling people, if you want to get in the house, you have to be resilient. You have to be persistent. So go for it. So I still think, but I think that's also the biggest threat to this whole thing. Is the more that the resiliency continues, the more work the Fed thinks they're going to have to do, which is going to make the problem maybe more difficult or maybe more prolonged at higher levels for a duration that is unknown. Correct. And then that just cascades what the future problem we'll have to encounter is. And eventually the chickens are going to have to come home and roost. Rates I think also are shocking people because this is not customary. Yeah. This is not customary for us in the industry, for people on the buying side, realtors and people selling. It's just not customary. And I think it's going to take time for people to get used to this.
Yeah.
I don't think we're going to see 6 or 5 in the next year, maybe year and a half.
Yeah.
And I'm sorry to say that prediction. I would love to be wrong. I absolutely would love to be wrong on behalf of everyone that can benefit from that.
Yeah.
But I'm just saying right now that the resiliency is going to continue this pursuit down this track. Some people are going to get in, some people are not. And it's going to make the Fed's job even harder.
And that, we just got to take for account that these are predictions.
Yeah.
We don't really know.
Absolutely.
I mean, anything can happen next week, next month, next day. Who knows? The market's just that volatile, right? And so things could just change in a heartbeat. So we can't go by these predictions. These are just good things for us to kind of put based on the current data that's going on. But please, don't think those are facts, okay? Too much will change. Just kind of like our weather. We're supposed to experience a hurricane. Right?
Yep.
That was predicted, and boy, everybody was wrong. I had everything chained up, and it didn't happen. You know, I thought I was just going to see the Wizard of Oz coming in with my house rolling up. It didn't happen. Those are predictions.
Yep.
So,
No, I don't have anything.
Okay.
what?
All right. Well,
You're silenced.
Well, that's okay. It's a good segue. Let's talk about our key takeaways from the show today, guys. What was something you learned new today, or something that stood out to you?
So, you know, the biggest thing that stood out to me is just knowing that the redundancy. It just becomes redundant information. You know, supply and demand is going to be there. I think we're going to continue to have this conversation as we move forward. So it's not something new that, whoa, it strikes me, but it's just crazy to see everybody's talking about the same thing because we're all having that same problem, that same issue. You know, the takeaway is prepare.
Yeah.
And we've been talking about that. Just prepare, be ready, go out there, get approved now. So if you are in FOMO or you are in need, it doesn't matter which direction you go. It's not going to cost you anything to be prepared. It's just going to cost you time to work to actually submit your loan application, submit your paperwork, and then just go to whomever you feel you're going to be confident, comfortable with that's going to help you and guide you through the process of, you know, purchasing a home, right? Very simple stuff. So that is my biggest thing. Like, just be prepared.
Your key takeaway, Brian?
No, I totally agree. And what I take away from this is, okay, well, you know all this information. What are you doing about it, right? You know, take action from what you're hearing this, because these numbers, I'm pretty sure we've talked about it over and over again, like William said, and they haven't got better. They're probably not going to get better, but you do know what you can do for your situation based on this information. So for me, take this as yet another eye opener or another lifeline to say, hey, if your situation is not where it needs to be, right now is the time to basically make that pivot, make those corrections, or do what you need to do to get to where you want to be in 3 to 5 years down the line. But make a plan, prepare, because these numbers aren't looking like they're going to change. The climate doesn't look like it's going to get any better, but you can better your situation and you can control your situation. You can't control the economy. You can't control the Fed. You can't control the rates. You can control your actions, your disciplines, and the steps you take to get to where you want to be.
Correct. The best thing, right, is I'm the problem.
Yeah.
But I'm the solution.
And that right there, that mentality, everybody has problems, but if you focus on the problems, how are you going to get the solution?
Correct. So, the biggest thing is just be prepared.
Yeah.
Go out there and just figure it out. You'll figure it out and just use the proper guidance to get you to it, you know, 100%. To whatever you're trying to do. But take action is what you said. That's the key word.
Have a plan.
So my key takeaway today, guys, is winners will win. Winners will win. And this comes back to your attitude point. Like, yes, we can talk about these things. I don't like delivering news about low inventory. I don't like delivering news about inflation. I don't like delivering news about all these mortgage rates, but it is what we're facing. So for the people that are going to face the storm and stare straight at the eye of the storm, you're going to make it through. So I want to encourage people watching and listening that if you're a winner, you're going to win in this market. It doesn't matter. Even though there might be less inventory, rates will be high, you're going to do what you need to do to prepare yourself. You're going to persevere, and you're going to make it through. So I am super excited about that. And I think that this is going to create a new breed of homeowner that is going to be much more resilient in the long term and not be trying to get in a house every 2 years, 3 years, 4 years. This is going to be for people that are going to buy and hunker down and stick with their place and really fall in love with their place more than maybe we've seen in our time in this industry.
Ah, wow. Yeah, I like that.
I think that could be a topic for another podcast.
Amen.
The new breed.
Yeah, Lonesome Mike, what was your key takeaway from the show today?
Yeah, so not to sound redundant, going off of what Brian and Will said, my key takeaway would be simply keep an eye out on the trends. For example, you see low inventory, okay, home prices are going to start going up. You see in the news, oh, inflation's pretty high. Well, I can expect interest rates to probably be higher when I go to apply for a mortgage. So, I mean, for a regular consumer, which is, most of our audience and not so much an investor, I would say set yourself up for success now. Because I mean, even if you don't pull the trigger now, you at least have an idea of where you're at financially. You at least have a clear mortgage plan going forward, which I mean, having a clear plan going forward is important for literally anything you do, right?
Awesome. Great feedback, man. Good input.
Clear
Okay.
mortgage plan.
Okay, rapid fire shot, guys.
Lonesome
Favorite part of the show.
Lonesome Mike.
Favorite part of the show.
Lonesome Mike.
Not side piece, Mike. Yeah. My favorite part of the show. Lonesome Mike. Lonesome Mike. Favorite part of the show.
My favorite part of the show is simply getting to be a part of it.
Yeah.
Favorite part of the show. Did you know Cal Half was coming back?
That's right. That's right.
Lonesome Mike it is.
All right, guys. Well, thank you so much for joining the Mortgage Heroes Weekly Podcast Show. We appreciate you watching. Remember, if you're watching on YouTube, remember to subscribe, turn on notifications so you see every time we upload a new video. And if you're watching on Google or Apple Podcasts, make sure you follow the show and do direct downloads so every week when we post, you get it first.
That's right. And please let us know what you guys want to talk about next.
All right. Thank you guys for watching. We'll see you
ya.
again next week.
Bye.